What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is May 24th of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, we've got to talk about why things are about to get shaky and crazy in the crypto space. We're not only going to be taking a look here at Bitcoin's price, which is giving a lot of signs that a further move to the downside is imminent here in the near term, but outside of that as well, we've got to talk about the altcoin space, the meme coin craze, and on top of that, talk about equity markets and the macro perspective of what's going on right now and all of the major events that are lining up here that could lead towards some serious volatility events in the market. We've got a lot to discuss in today's video. If you guys happen to enjoy it, consider dropping a like. It's one of the greatest ways you can support the channel, and it's free to do so. And if you guys have the time, please stick through to this video. It's going to be an important one to watch. All right, let's go ahead and kick off the rambling. So I want to start here by taking a look at Bitcoin here on the daily time frame. Bitcoin is already giving off a lot of worrying signs here, because not only do we have almost nearly a 3-week trend here of Bitcoin being in a red trend here on our leading momentum indicator. So no longer is it kind of red and blue chop. We're seeing a clear red trend on the daily time frame with any inability to get towards a price level to get that trend flipping back to the blue. But once more, it's important to focus on some of the time-tested indicators like the 200-week moving averages as well as the 200 days between the exponential and simple moving average. And here's a very concerning reality that investors need to face. After passing the 200-week moving average, we talked on this channel about a very important dynamic. This was going to be one of our final real dynamics to see whether or not we would be in a new bull market. And back a couple months ago, when we did pass through here in March, I said, hey, that's great, guys. It's awesome that Bitcoin's moving, but can it hold the 200-week? Because if we take a look back at practically any cycle, essentially speaking, if Bitcoin cannot hold above that 200-week and be able to sustain a substantial move where it's above it and starting to make support on the 200-day, we are likely not in a broader term, long-term uptrend. That is the key reality we need to face. We essentially need to get above that 200-week moving average and be able to hold above it. If we can't, we are going to go crashing back down below there into the 200-day pocket, which is already a couple $1,000s below it. And if we can't hold that, then you're practically entering into no man's land where you have to look for levels of price support. Now, the key thing I want to emphasize here is that it's not just a matter of looking at some moving averages or a momentum indicator that's got us concerned here. One, the narratives that have been driving Bitcoin's rally have practically fallen through. And once more, whether you agree that those realities or those narratives are true or not, the simple reality is that we have not been able to reclaim this range of prior support in the last bull market as support once again. It is in fact serving as resistance just like it was back here in May. And in fact, this time we really only had one significant retest in that channel, slowly but steadily fading out here over the last month to a month and a half essentially. So this is not the kind of price action we want to see going into a new bull market as people are talking about. And again, I don't want to spend time on it, but you guys know we've dispelled a lot of the narratives of de-dollarization, a lot of the narratives of liquidity flowing into the crypto space from banks. It's just not happening. None of the metrics show it. Price action is not showing it. We have been flat here for more than 2 months now. No wonder, generally speaking, people are not keeping so active on the crypto space. No wonder the only trend that's been taking people's interest right now in the entire altcoin space, which has been fading since back in April and is basically where it was back in January or back where it was in October, or lower than where it was when we sold altcoins around here in August of 2022. No, instead, we're seeing a red trend flip here on the altcoin space because the only thing people were interested in was meme coins like Pepe. And the sad reality is that when you're in a contracting environment where central banks are contracting global liquidity, new money is not flowing into the crypto space. We see that through the stablecoin metrics. We see that through general, traffic on the web, on social media. We can see that there's not the kind of euphoric speculation that's going on. Speculation doesn't do well for very long in bear markets, and people take advantage of any upturns they can get because there are a lot of players who are underwater, who are overexposed, who are essentially in a position where they're trying to make up for previous losses, and they'll do anything, even deceive people and play off people's gambling nature in order to make back or recoup against certain losses. One person's gain in this event is most certainly another person's loss. And that is how these games play. These tokens are being created by people who know how to play the system, who know how to slowly rug over time and make money off of you, because they know that a lot of other people are in the same position, essentially chasing the trend too late and trying to make up for prior losses. Now, again, a big thing I want you guys to know about here as we kind of wrap up talking specifically about the crypto space here, because the macro picture is going to give us a lot of alignment to this point here. We're seeing obviously that Bitcoin and altcoins are not showing up to the plate here. However, there are always those opportunities in the DeFi space. People are always trying to make these trades. And if you are going to do that, right, we always speak out against kind of leverage trading and a lot of the over speculative activities here in the crypto space. But promise me that if you are going to use MetaMask and you're going to go out there and interact with DeFi protocols, swapping in between tokens, that you guys take the time to download our sponsor, one of our long-term partners here on the channel, WalletGuard, which is a free-to-use tool that is going to prevent you not just from worrying about whether or not you're going to make money on a trade, but more specifically is going to help make sure you don't lose everything interacting with the wrong contract, making the wrong type of swap or transaction. When you think you're transacting your ETH or stablecoins for some type of meme coin or some other type of investment, maybe you're dollar cost averaging into your favorite altcoin, whatever it may be, if you're using a self-custodial wallet, if you're going into the wild west of DeFi, make sure you have WalletGuard installed on your browser. It is going to allow you to make sure that you're getting protective URL scanning, essentially making sure that you're not going on a fake Uniswap or SushiSwap or PancakeSwap website or any other DeFi protocol for that matter, in order to guarantee a much higher degree of security versus interacting with a fake website that probably has malicious contracts. Outside of this, well, you also have transaction simulation, so you actually will know what you're engaging in when it comes to your transactions. This is something that is so imperative because if you use MetaMask or any of the leading wallet browser extensions, you're going to get some random string of hexadecimal code. You don't really know if you're swapping into that Pepe token or other meme coin that you're trying to buy. So again, guys, I'm not here to encourage that you guys go out and buy meme coins. That's not my point here. My point here is that if you are going to go out there, because I know that there are a lot of people who maybe don't trade exactly like I do and have different risk profiles, make sure you do it in a safe way. Don't have an overt risk profile and not use something like WalletGuard. I'll leave a link down below in the description where you guys can get access to it for free. And I think, again, it's going to be something that's going to help you guys on your journey within crypto. But taking a look here, the broader altcoin space is just not flashing any signs of optimism. A lot of people got excited. I can give an example of this back in October of 2022. Dogecoin had popped up over 105%, and a lot of people pointed to me and said, Nick, if you don't believe this is a bull market, I don't know what I can say to convince you. Well, let's take a look here at what Dogecoin did, right? We looked at our momentum indicators here. I was watching this back in the previous period of time, back towards the close of 2022, and I was watching for that monthly indicator to switch towards potentially going blue. If it did, that might get a little bit interesting for me. And then I started asking and kind of questioning a bit on my macro thesis and thinking about, have things really changed here? Can the Fed really back off? Is inflation down, right? I didn't even get to that point because we didn't get a blue flip on the monthly time frame, right? It was a clear signal that the market is not ready to continue moving higher. And since then, after going up towards a peak around 15 to 16 cents, we are back down towards 7 cents per token. Dogecoin didn't even move during this period of time. So what does that tell you when Dogecoin, the biggest meme coin out there, doesn't even make a slight move to the upside during this meme craze? It was up 3% last month. All the gains that it made faded. If Dogecoin doesn't hold up, what does it tell you about Pepe? What does it tell you about all these other meme coins that did well? It tells you that it's a fake trend. It's nothing substantial. There's nothing real to it. It is people propping it up with initial liquidity because in an AMM, it is the concept of a simple, time-tested rug pull. If you enter liquidity at the earliest point possible, new entrants come to the market pushing up the spread, essentially pushing up the rate. You can unload with that same liquidity you injected into the system at a higher rate. And you make a markup. You sell at a higher rate, those investors are left holding the bag. That's the name of the game. That's how rug pulls generally work. There are different types of them, but this is a essential slow rug. And it is going to continue playing out anytime market investors know that traders are going to be gullible enough to follow it, because there is no real trend right now in crypto. DeFi has been stagnant for the past couple years. As someone who invested a lot of money and time into the DeFi space, I'm really disappointed with where DeFi is right now. What's there to be excited about right now? I just ask people, name me one application where you've been like, man, I'm using this thing every day, or I'm using it at least once a week, and this really has improved my experience in the crypto space. This thing has, a potential to eventually become a protocol that generates millions, if not billions of dollars of revenue, and really become a market leader and have a multi-billion-dollar token. Name one app, one application. And I hear people talking about maybe layer 2 infrastructure plays, but guys, the thing is, just because people use those things, you need to ask whether or not there's a business model. And even beyond that, ask a more simple question. You may really like these protocols, but over the next year or two, are there going to be more people buying at the current price or selling at the current price? And I got to tell you guys, in a contractionary environment, it's going to lean towards the latter. It's going to lean towards people selling. And that is why Dogecoin, it has been unfavorable to purchase Dogecoin ever since back during when the market truly peaked in altcoins in April and May of 2021. That was when really the euphoria was in. And time and time again, just like in previous cycles for Dogecoin, if we take a look back at history, it's a great gauge to look back on and learn about how it's only favorable to trade altcoins when we're really in a bull market and when we're in an altcoin cycle, and they come very rarely. The vast majority of the time, altcoins are bleeding, not just against Bitcoin, but in dollar terms as well. However, we need to take a step back and look at the macro picture, because if equities are not holding up, especially those that are the defensive plays, not the risk on tech plays, then we are in for a lot of pain, not just in those stocks, but in high risk areas like high tech growth stocks, or even worse, in the crypto space, whether it be Bitcoin or altcoins. Let me explain. Now, when we take a look at the Dow Jones, it's telling us a lot about the current status of the market. Since back here in April of 2022, over a year ago, we've continuously faced resistance at this price range. Here in August, here in November, here in January, and also here in April. Time and time again, around this point range at around 34,250, this is deviation territory where prices get up there, people start to think it is the beginning of a new bull market, and then prices roll right back over. There is essentially a demand, or in this case, a supply zone, where people are unloading positions at these rates. So what does that tell us here, right? These are the defensive stocks, the stocks that rallied here from October to November off of the idea within a matter of a month. It went from around 28,000 points towards around 34,000, right? Over the course of a month and a half, give or take. Essentially, people were going into these because these were the plays that were going to be able to survive the inflation wave. And it was just time to go ahead and pick them up because they're paying good dividends. They've got strong balance sheets. They're going to be able to weather the storm, so to speak. And you're not going to stop buying goods from names like Johnson & Johnson, or you're not going to stop going to the hospital. So United Health Group will be good. All these big names, they were the safe plays, right? Well, this price action since November is a very worrying sign. You've got slightly lower highs each and every time, or at least general chop at the same range. And you've got lower lows that are expanding lower and lower. And the question is, as we expand this previous line of resistance that we did break through, the question is, when we come down here, will we be able to see buyers picking up off this range? Because if we don't, and it goes further down, that is a really worrying sign. Even the Dow Jones just coming to revisit this range or down here is going to spell bad for risk on assets like crypto. It is going to set a very clear tone that essentially we are very well likely repeating history. We are much more likely now to be repeating what we saw back in the dot-com bubble. Let me explain. This is a comparison that I've seen no one draw before, guys. But if we go back, taking a look at history, we can see the Dow Jones during a multi-year period, roughly around a 3-year period, had a essential long-term bear market that got progressively worse over time. Now, you notice here for the first years, we led up into the peak of the dot-com bubble, which is really here in the late 1990s into the early 2000s. The Dow Jones actually held out relatively well. During this period of time, we essentially only saw the Dow Jones from its given peak dropping around 17% during each of these corrections, around 15, 17%, give or take, on these different drops, right? Generally the same story here. And this was all the way until April of 2001. So you're talking about a year and a half from the previous all-time highs in the Dow Jones, roughly speaking, right? And that's something that can lead a lot of people to think, oh, okay, this is the correction, time to get in. And not to mention when you get these kind of breakouts that go above a certain range of price or deviate, essentially people think, oh my God, this is the time to go and I got to FOMO in. But that's exactly when prices pulled back down and it started to get worse. And it started to get worse. And it started to go down and out and chop in a range that was much lower here, essentially from those previous highs, dropping all the way down 38%. Now that was the defensive stocks. What's going to happen in the tech stocks, the more high growth stocks? Well, those stocks went down over 70%. IPOs that were the darlings of that bubble disappeared and they never came back, leaving investors for a long period of time in a state of disbelief and keeping them from wanting to invest in the market. A whole generation of investors lost significant amounts of money. This is actually a big reason why the dot-com bubble itself, not just from a technology perspective as the technology took time to improve, but it's a big reason why people didn't come back to buy stocks throughout the next coming years, and why defensive plays were usually where capital flowed to, because there wasn't a huge retail investor crowd. Not until 2018, 2019, 2020, and 2021, where things got really exacerbated, especially during the COVID blow-off time. All right. So this is, again, it's all about psychology and capital flows. And if we take a look here, we are seeing striking similarities here. Not only generally a still downward trend here, no real significant uptrend. Right now we've been in a bit of a neutral trend here for the past few months. But if this starts to break, if we start to see on the monthly time frame that this, inconsistency of red and blue flips starts to turn towards consistent red, we are likely in for a traditional bear market correction, a significant correction from those prior highs. We've still got a ways to go. The lowest we went here was around 22%. To get that traditional 33% correction, we're coming down here into territory we haven't seen since 2018 to 2020. And the question is, you got to ask yourself whether or not you're prepared for that. If you're dollar cost averaging into the market, are you doing it too aggressively? Perhaps you want to slow down the pace of that, preserve some capital to buy in when we get greater levels of capitulation. It's up to every person. Everyone's got to place their bets. But I got to tell you guys, it's not looking good. XLF here, the financial sector, I got to tell you, there's very few periods of time where the financial sector does not do well and the stock market does well. They tend to go in pretty good hand-in-hand correlation here. And over the past couple of months, actually over the past year, my apologies, since back in June of 2022, financial sector has been holding by a thread on the 200-week moving average. If this snaps, if we clear through this level, it is going to mean really bad news. It's going to spell bad news not just for the financial sector, which is a large part of people's 401ks or retirement accounts, but on top of that, it is a huge weight on the overall global trends. We have not been able to get back above the 200 days since we broke back in February and March during the period of time of the regional bank crisis with Signature Bank, with Silicon Valley Bank, as well as Silvergate Bank and all these names, such as First Republic Bank, that are continuing to go under. The IAT ETF, which is the iShares US Regional Bank ETF, while it has made some moves to the upside as speculators are buying the dip, a lot of people are estimating we're in the same kind of chop range here of 2020 and the buyers are just going to come in and save the day and that the worst is behind us. I don't know, guys. While a lot of the skeletons have been revealed out of the closet, it doesn't mean that stocks can't continue to go lower. I think we've got a much lower range here to potentially correct here on these regional banks. And history shows us through a consistent downward line of support, the regional banks are getting weaker and weaker as time progresses, as banks have continued to consolidate. And now with the crisis of bank runs, it's not something that's really benefiting crypto. It's just that people are moving money into more defensive banks. Case in point, they're moving to defensive banks, so they're going where they can get serious yield, so they can hedge against inflation. And that is spiking up the VIX towards potentially having its highest weekly close that we've seen since back in early April. This to me looks around the time where I'd start expecting some serious volatility when you start seeing the VIX spike like this. Now we have been in chop for the past couple of, really the past month and a half, so to speak. But we've got NVIDIA earnings coming out later today. And that's going to let us know if the AI narrative is really real. Is it really justified? Are we seeing some new hyperbolic amount of demand? Because this is when it gets real, and we really got to see whether or not the AI hype is real. If AI hype is not real, right, this is just a facade, right? If NVIDIA really can't have the forward-looking guidance to justify a 180 PE ratio for its valuation, 180 times, 180 years worth of earnings is what NVIDIA is being valued at right now. Keep that in mind for a second, right? If NVIDIA can't keep on its promise, if AI is dead, come back to the question, what is the narrative? Because central banks saving this is not going to be the play here. They're already looking at doing another 25 basis points. The Fed governors are on board with Jerome Powell on this. So if it's not Fed liquidity, we got to hope that the existing money in the system somewhere, whether it be institutions or retail mom and pops, that they're going to be buying stocks for some reason. What's the reason? If the AI narrative fails, the relief rally fails. And if the relief rally fails, we are going right back down where we came. That's going to be brutal for NVIDIA. It's going to be brutal for a whole range of high growth tech stocks that people have been buying the dip on, the FANG stocks that people are betting are just going to come raging back. And it is going to be detrimental for the defensive stocks, the dividend plays that people are buying into because, I get some passive yield, but the principal that they bought it at is going to be lower. And on top of that, it is going to be bad for crypto. Really, really bad for crypto right now, guys. And I think this is a period of time. I've feared something like this for a long time in the crypto space. And I'll be completely honest in saying that we have not really seen this. Usually altcoins just kind of slowly bleed out over time into irrelevancy, new players coming to the scene. This is where, with the lack of market makers in the crypto space, after Jane and Jump Street have essentially left the crypto space, Jane Street and Jump, those are the two big market makers. Now that they're out of the space, now that the stablecoin on-ramps are out of the space, right? There's a lot of people are essentially not being able to get liquidity into the space because of lacking banking partners. We've seen that with stablecoin liquidity. Now that all of that is in the picture, people are looking for the only thing, which is a way out. They're looking to get out of the market. We've been saying it for months. It's the reason we sold into cash in August. It's time to play defensive, guys. This is what makes us different as macro traders versus the crowd. Doesn't mean we're always going to get it right. Doesn't mean we're going to catch every single rally or short every sell-off. But we aim at surviving. We aim at being in a position so we can thrive during the next bull market. It's not about catching every opportunity. It's about asking what you can afford to lose. And so many people aren't asking that question right now. And while it may be paying off for them right now, taking speculation in times where it's relatively good, good times don't always last, especially in contractionary environments. I'm just being real with you guys here. I just want to be honest. I want to give you guys my opinion. You guys come here for that. And again, we are continuing to stick to our guns here. There's no reason not to. We are not missing out on anything. We're doing fine. We're staying in our lane. We got cash ready. And we're looking for the next big trade. And who knows, maybe AI could do that. But we got to see the numbers. Because paying a 180 PE multiple on the leading GPU manufacturer in the world just because people believe AI is going to change the world. ChatGPT has been around since October. Where is the killer application that was built with ChatGPT? Where was the incredible bolster of productivity that we've been promised? People are definitely using it, but it's not some S-curve, absolutely astounding technology. AGI, right? Something that a lot of people are looking forward to is probably a long ways away. AGI is very different. Artificial general intelligence, something equitable to a human, likely far off in the future. It's very difficult to build something that can mimic a human. And while OpenAI and many companies have made some great progress, and I think it is going to be a generally net positive thing in the future, like the internet, like most technology, it takes time for this to be realized, whether it be in the development cycle or the cycle of adoption. I think all of us know that in crypto quite well. We love crypto in a lot of ways. There's nothing stopping people from using it, but people just aren't using it. Use cases have fallen flat. Anyways, I've rambled on a good amount, guys. If you've lived this long to see the end of the video, I hope you will drop a like and say something funny in the comments. Let me know that you made it all the way. I love hearing from you guys who make it this far in the videos. And I want to keep creating content. I'll be here during bull and bear markets. You guys can know that. I will always be here so long as I want to do this YouTube channel. I will be here for you guys during these periods of time. And I'll let you know when we strike, generally, like when we're really getting optimistic. And yeah. Anyways, check out Wallet Guard down below if you guys are interested. Make sure you go out there safely in the crypto space. Until the next video, I'll see you all in the next one. Take care, everyone.